Our breaking news coverage of the Bank of Canada continues, surprising the market by increasing interest rates by 25 basis points, taking the rate to 4.75%. In the statement, there was a reference to the housing market, noting that it has strengthened. To discuss what the rate increase means for the housing market, still on the desk with me, we've got Earl Davis of BMO, we've got Francis Horodelski, and I'd like to bring in now Steve Ranson, who's the president and CEO of HomeEquity Bank. Steve, thanks so much for being with us. Since the pause was put into practice, we saw Canada's housing market take off. What does a 25 basis point increase to the trend-setting rate do to that trajectory?
I mean, obviously, it doesn't help affordability, so there's certainly going to be ongoing challenges for people there. I have a bit of a different view than some commentators in terms of the housing market. What's driven it in the last quarter. Stability, I think, is really important, and confidence of consumers in knowing what their what's their price going to be, what's their cost going to be. If we get and so when the Bank of Canada started, later than they should have in most estimations, but certainly once they started, and it just seemed like every single meeting there was an increase. That's a lot of uncertainty. Housing markets slowed down. Then in January when they stopped, and your commentators were saying earlier, in January it seemed like, okay, this is it. Rates are going to be stable and inflation is coming down. I think that's what really helped the housing market. So if we're back into a cycle now where rates are going up, the Bank of Canada said, in their press release, they're resolute about beating down inflation. So potentially that means there's more coming in July. We're back into that cycle of uncertainty. So it should help slow down the housing market.
Yeah, I think a housing market will slow down marginally, but it'll still be great demand, as I mentioned before, the delay in mortgage rates. But the most important thing for housing is employment. As long as people are employed and we're seeing record employment, they are able to pay their mortgages, there will still be significant house demand.
Yeah, and I would agree. Employment is very strong. Wage inflation isn't strong, so people are getting more money to be able to pay some of these higher interest rates. And there's a lot of net population growth in the country. Like all of those things are driving housing separately, really, from what happens to interest rates, for sure.
This is all being done to avoid a crisis when it comes to inflation, but it certainly will affect certain people and it will make them more vulnerable. Can you talk to me about that side of things, the state of mortgage holders today, maybe particularly those that have a variable mortgage, the ability of Canadians to continue to endure higher interest rates?
Yeah, it's pretty tough being a variable mortgage rate payer, for sure. I don't know what the trend is at other banks. Certainly at our banks, we saw a big swing from people taking variable rate mortgages 12 to 18 months ago, heavily into longer terms, 3-year, 5-year. So people who've got mortgages in the last 12 to 18 months are probably in pretty good shape. It's the ones that are going to be maturing in the next little while, that are looking at potentially 300 or 400 basis point increases in the mortgage rates. That's going to be, it's dramatic.
I guess the other side of the coin is, from your perspective, but also other lenders, how do they deal with that? So your own funding costs are going to go up. And at the same time, notwithstanding, you mentioned that many people refinance maybe 12 months or 18 months ago, but the credit quality of existing mortgage holders might go down. So how does that work through either your own company or just more broadly through the economy and through the financial system?
Well, I mean, the great thing for our customers, right? We're in the reverse mortgage business, so people are never making payments really unless they choose to. Where we are seeing is a greater number of people coming from conventional lenders, where the challenge of making those payments is just becoming greater and greater and greater. So a very significant percentage of the people who are getting reverse mortgages from HomeEquity Bank are actually coming from other lenders because they're having those challenges, making those payments. Now our demographic is older, average customers in their early 70s, but I'm sure those trends are playing out in other institutions as well. It's challenging for people coming off these, relatively, historically low interest rates.
Steve, maybe you could take us into the psychology of the average home buyer right now. You started off talking about affordability. According to RBC, the percent of income that's going to home ownership is at multi-decade highs. It's north of 50% just to own a home. I feel like the psychology aspect of it is not often addressed or brought into when we're talking about interest rate increases, but just how willing are Canadians to reach for home ownership?
It sure seems they're really willing to do it. And I think part of it is, there's just this long-term track record where owning a home has been a great financial investment. And even with the dip we've seen, from Q2 last year to probably, Q1 this year in home prices, now we're back where home prices are going up again. It just hasn't been proven to people that owning a home is a bad investment. On the contrary, cycle after cycle, it's proven it's been a fantastic investment. And I think that drives people to want to buy a home. And then rental markets have been very tight in most major centers across Canada, which again means, okay, if I'm paying all this money in rent, I may as well pay a little bit more money and feel like I own my home and I'm getting somewhere.
So are a couple of interest rate hikes going to fundamentally alter that picture?
Well, you have to believe so. And I guess, I believe the Bank of Canada believes it. I mean, they don't, as we all know, right, they don't specifically target home prices, but the fact that they've actually mentioned in this press release, which they don't do in, every announcement, means it's certainly on the radar, and it's something that they've got to be concerned about. So it's got to have an impact at some point. At some point, higher interest rates will offset wage inflation. And as wage inflation comes down, the housing market has to slow down.
How does immigration complicate the effectiveness of rising interest rates?
Well, net 1 million people last year in Canada, which is, I think, the highest ever. And, immigration rates are not coming down. That's obviously a whole other debate. And there's probably a lot more research to be done on what the impact is on house prices. But I think the evidence is most new immigrants to Canada want to live in the major centers and are having some sort of impact either on rental markets, more than likely initially, and housing market.
Internally at HomeEquity Bank, do you have a forecast for rates from the Bank of Canada? You mentioned the term resolute. That was in the statement. What is your own internal forecast from your own economists or from you?
Well, my forecast has kind of, changed dramatically, really, in the last 6 weeks. I was like, the earlier discussion in January, I thought, okay, there were some people thinking rates were going to come down. And I was like, well, I didn't see that happening. I certainly saw rates as being constant through, 2023. Now, that 25 basis points, we're really going to have to think about it. There's probably another 25 basis points coming, maybe not in July, but possibly in September. If inflation doesn't come down, and it doesn't seem like it really is. I think a lot of people were concerned that, I can't say it's easy, but, getting from 8% to 6% to 4%, was one thing, but really getting down to that 2% number, that is going to be challenging. And it just seems like we're a long way away from that. So there's probably another 25 basis points coming this year.